Diana Glassman. She's the ESG Director of Engagement at EOS at Federated Hermes. She engages with Fortune 500 directors and senior executives on behalf of over 50 institutional investor clients with over 1.75 trillion in assets under management on strategy, capital allocation, and ESG issues that impact long-term financial value. So welcome, Diana. And we look forward to hearing about the importance of the engagement role in ESG and who are the main stakeholders, what does it take to align incentives in the best way, and take it away.
Thank you. First of all, can you hear me?
Yes.
Wonderful. We had some earlier technical issues. And thank you, Diana, and thank you, Peter, for having me here and my fellow panelists. Peter is a luminary in this field. It is great to see the traction this field now has, largely to Peter and his efforts. Peter, I never told you, but I used to look at your at these summits, PowerPoints afterwards, hoping to get to know you someday. So very honored to be here. Thank you. Our clients, as Diana said, we have quite a few pension fund clients. And to give you a little bit of backdrop on this means that they are what we call universal owners. They own public equity, private equity, public debt, private debt, infrastructure. So they own all the various asset classes, and their beneficiaries, they will owe, they have obligations to their beneficiaries who are pensioners for 15, 10, 20, 30, 70 years down the line. And so we are very interested in long-term financial returns. This is why we are so very focused on issues of ESG, capital allocation, strategy that do impact the ability of these companies to create long-term financial returns for their beneficiaries, and also the system-wide impacts of their activities, because the health of the full system over time impacts financial returns, as well as the world that our beneficiaries will be living in. So we enable institutional investors to meet their fiduciary responsibilities. So this is about financial returns, but it is also about social and environmental returns. Our company has been in this for a long time. For those of you who are not familiar with EOS at Federated Hermes, the PRI, the Principles of Responsible Investing, was drafted and signed in our London offices. And we run about 20% of the CA 100 plus engagements. So what is engagement? Engagement is one of these practices that is at the forefront of the ESG movement that's coming over from Europe. It's pretty established in Europe, and it is here now, again, gaining traction in the States, which is excellent to see. So what we do is we help the companies that our clients are invested in to think about the issues and hopefully over time enhance their performance in a way that generates financial and social returns. So we go in and we speak with the senior executives and directors of these companies. We look at data. We ask them to provide data. We are the drivers of demand for the products, or the extra impetus for demand for the products that my fellow panelists here are providing to the market. So thank you to our fellow panelists. We are a user of your products, a consumer of your products. And we also help our clients get underneath some of the various data sources to try to understand how the companies and directors are thinking about this information. So in terms of our clients' priorities are climate change, human rights, DEI, human capital. So it cuts across quite a few issues. So what I thought I would do right now is share with you, again, from a customer perspective, as consumers of your product, drivers of demand for your product, what are some of our clients' priorities, and what sorts of challenges that we have and that you are helping us or will help us to fulfill. So first of all, our clients have largely signed the net zero asset manager, asset owner pledges. So they themselves have scope 1, 2, and 3 reporting requirements. And as a result, they are engaging with all of their holdings across sectors, whether they're financial services, oil and gas companies, big tech companies, and other companies, in trying to understand these issues and performance against these issues. So in terms of our clients' demand on the climate side, we're looking for scope 1, 2, 3 disclosures and targets, TCFD reporting, which my fellow panelist has discussed before. We're looking at measures of strategic alignment with strategies that we think are lower risk and higher return. So this would be scope 3 absolute targets, scope 3 intensity targets, interim targets that help us get to net zero targets. We're looking at key metrics, so very in-depth financial metrics. In the case of oil and gas, for example, oil price assumptions, natural gas assumptions by key market, carbon price assumptions, and then going deeper into rates of returns, terminal value, discount rate, lives of asset, retirement assumptions, all these sorts of financial assumptions that we can evaluate to see if these companies are sort of thinking in alignment with our clients' interests. A key area that has emerged recently, in addition to CO2, is methane. One of the challenges with methane and others is that people have used emissions factors as opposed to actual measurements, and everybody knows that these are off. So we are very, very focused on methane emissions, and we are interested in consistent, comparable, verified disclosures that will help us understand if we are reducing methane enough to have a shot at keeping temperature rise to 1.5 degrees Celsius. And these are very near-term data that we're looking at in the next 10 years. So we need near-term data as well as indicators of long-term strategic performance. We're also looking at indicators of board oversight, their capacity and their structures. Executive compensation is very important, understanding if companies are incenting their senior executives in alignment with goals and objectives that drive financial performance. So not just simply cutting and pasting financial performance, but really aligning compensation with the drivers of financial performance. Those are some of the climate level areas that we're focused on. But another important area is the S and ESG. S and ESG, these are more emerging frameworks. We need more information. There are frameworks that over time will develop, and we think, like climate, will ask companies and boards to think about a more expansive set of impacts on society that, again, both impact the financial performance directly of the company, as well as the health of the stakeholder systems upon which the financial performance depends. I will pause there. I can, in the interest of opening up for questions, or I can go on as needed.
Let's keep going.
Okay, cool. Let me speak a little bit more in that case about the S in social, because this seems to be an area that active investors, that's quite promising for active investors. So typically, let's think, for example, about diversity, equity, inclusion. We believe that clearly workforces need to be more representative of the societies in which they operate. We believe that this creates financial performance through a whole bunch of measures. For example, better decision-making, a greater recognition of impacts on society, new opportunities in marketplaces that may not be visible, also harms in society. So one of the areas that I lead is technology, and co-lead of technology engagement at our firm. So when you look at AI, and I know there's going to be AI discussion, but a lot of AI, the algorithms that are created by very non-diverse sets of employees. So STEM in technology is known to be pretty non-diverse. A lot of times you'll see biases, unintentional biases about race, gender, and various other characteristics propagated in the outputs of AI algorithms. And these can be very, very harmful in terms of perpetuating underlying negative stereotypes and beyond offensive, harmful behaviors. So this is something that we're very, very interested in reducing, and we are looking for metrics, including perhaps via new racial equity audits, civil rights audits. These are third-party provided audits of the impacts of race and equity on the workforce, but also on broader society, to help us identify what are the harms and also to help companies identify what are the opportunities to create value from serving underrepresented marketplaces that have needs that others have not been able to meet. So we are very much looking at the opportunity set, not just the reduction in harms and risk mitigation set. But together we see the S in ESG as a very ripe area for future development, where we see a lot of value creation, holistic value creation, both financial value creation, as well as enhancing the quality of life and the holistic nature of the societies in which we all live.
Absolutely. And thank you so much, Diana. This is very relevant. And especially as you mentioned, having a holistic view of ESG that embeds the E, the S, and the G components accordingly. We have a few questions, and I'll start with one that says, similar to COVID, how much of a blip do you feel that the current Ukrainian war will cause in meeting ESG goals? And how much of a setback will it represent, if any?
Thanks for that question. I think that Ukraine is, first and foremost, on the G side. It's leading to a wholesale reevaluation of country-specific geopolitical risk that impacts the G. So G is really quite important, and the S, there's a wholesale human rights. There's a catastrophe going on right in front of our eyes. And so the human rights implications, and again, these are areas that our clients are very, very focused on, are very much front and center in people's minds. So this is not a blip. This is a reassertion of the importance of these factors in investment decision making.
Absolutely. Thank you. And the next question would be, knowing that more frameworks will develop in the future, what kind of frameworks do you see as the most common for companies to use for the S and the G part of ESG? And what kind of S and G metrics are companies disclosing now?
That's for me?
Yeah.
So we are as I said, we're a consumer, we're a driver of demand. What we are looking for is, and this is why we have a job. We go and we talk to the companies to try to understand what are forward-looking impacts. What are companies doing? What's their momentum? Where are there going to be changes? What do we think these companies are going to be doing, and how are they approaching these problems? And how are they either missing risks or affecting behavior that causes them to miss risk, or contrarily, are they qualified to look at these risks and think through really complex strategies and trade-offs and changing markets? So all of these are, I guess, what you would call intangibles. So what metrics have historically measured is what's visible, what's tangible. So we're relatively good at looking at, indicators that you can count, whether these are governance indicators, social indicators, climate indicators. I think what we're looking for are insights and where we see opportunity in the areas that are much harder to quantify. And this is what we're looking for. I'm not sure I'm the expert, but this is what we need and what we are looking for, and where we see opportunity for this group here, my fellow panelists, to develop. You know, somebody did mention private equity, and that is really interesting. I'd say private equity, as I mentioned, our clients are universal asset owners. They own everything, including private equity, private markets, private debt, infrastructure, real estate. I think that has historically been harder because it's less homogeneous, and it's just harder for one company to sort of get a grip on those, and also for earlier stage companies. But that's coming. That's absolutely coming. And to the person who was talking about embedding sustainability from the get-go and giving credit to those sorts of companies from the get-go, I think that the world has focused on the capital allocation stack, and so equity, fixed income, but alternatives, private equity, venture capital, even all of those are coming. And this is there's a lot coming on in that dimension.
Right, it's across the entire ecosystem.
Mm-hmm.
So do you think when we talk about net zero, does the finance and investment community view net zero as a desired endpoint or as an interim milestone toward net positive?
This is definitely a journey. And I'd like to jump on. Thank you for bringing up the net positive, because yes, it's net positive. And when you think about net zero, that's sort of a moment in time, but there are some industries that are going to have to come to net zero, net positive before other industries, and some countries in order for the overall average to come down to net zero. So yeah, net positive, that direction, that's definitely a direction to aspire to.
Mm-hmm. So if a corporation seeks to offset climate impacts and elects to install solar, for example, would that one-time solar supplying company be part of the Scope 3 emissions accounting?
With the what? So, you're putting me on the spot here, and I think this is a technical question, and I'd love to think about the answer and get back to you. I'd like to look at the question and really just think about it.
Yeah,
I'm not a greenhouse gas expert, but I know quite a few.
Mm-hmm. Mm-hmm. So let's move on to the next question. When we talk about, in terms of the ESG priorities, do your investors come to you with fully baked ESG priorities that they already have? Or does FH consult with them as well to help them set their priorities? That
is a great question. Thank you to whoever asked that question. We don't consult. We represent our clients, but I would say that our clients are mainstream institutional investors, and we represent their point of view. We have a process every year. We've just made it through one piece of the process where we get their input on what matters to them, and they help us develop our engagement plan so that we carry their priorities into the engagement. So the climate priorities that I mentioned, the human rights, diversity, equity, inclusion, workforce, those are their priorities, and we are helping them execute. That said, I think that there is a sense that there is a like-mindedness there. Definitely, we're not passive. I think we have a reputation for being at the front end of the mainstream institutional investor. We definitely do seek to transform the financial system. We're not shy about saying that. Again, within the construct of holistic returns, meaning financial returns, but also the sort of world, social world and environmental world where our clients' beneficiaries actually want to live.
Great.
So that is our perspective. It's definitely client driven for sure, very defined process, but it's a little bit of both.
And that's great to see that you see it as a journey and that you work with these clients and institutions on this journey. What does this journey usually look like? Does the journey have the same basic components for everyone, or is it different on a case-by-case basis? And you've been on a lot of these journeys.
Oh, well, thank you so much for asking again that question, and thanks to the person who asked that question. So we have these big picture priorities, but when we go and we talk to each company, it's very much informed by a sector point of view and a bottom-up company-specific point of view. So our clients, we develop our corporate governance principles that cut across corporate governance, financially material, as we all know. And then we also have an engagement plan on a sector by sector basis, thematic basis, theme by theme basis. And we use that as a backdrop, and we marry that with company specific, bottom up, in-depth research. And so we develop a plan actually for each company, which sets out objectives for that company based on material areas that we have identified where we believe that company has opportunity to increase performance, reduce risk. And then we have a series of milestones that we look at against each of those objectives by company. So we have a series of objectives by company, milestones by company. We measure our performance, we track their performance, we report them to our clients to see how we are, and we're very transparent about how we are, and the companies are progressing the client's objectives.
Okay, great. Well, thank you so much once again, Diana. It's fantastic to have you.